This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, from the June 2021 exam, we have a new introduction to our syllabus here in the realm of capital allowances. It's been a very, very long time indeed, probably going back to before most of you guys were even born, that capital allowances have been available in relation to the cost of a building. What we have seen for the last many years, and dating back, as I said, probably before you were born, have seen that capital allowances have only been available in relation to qualifying plant and machinery. Once upon a time, there was something called an industrial buildings allowance. Well, what we've now had introduced to our syllabus, again, as we've said, for the first time anyway, from June 21 exam onwards, is this structures and buildings allowance. Structures and buildings allowance. Now, in reality, it's actually been with us for a couple of years, but it's only now been adopted within the Tax UK syllabus. So for that reason, we will only be dealing with this new structures and buildings capital allowance. We'll call this SBA from now on. It's been introduced, which will only be tested in our exam for construction on or after. Now, there's two dates very close together. One we're perfectly well used to. The first one there, the 6th of April 20, it being the start of our tax year, the 2021 tax year. And that is true for unincorporated traders. As you'll see from chapter 4, as you've seen rather, in chapter 4, we are dealing with income tax for unincorporated traders. But in deriving the tax-adjusted trading profit to include within the income tax computation, we need to compute and deduct capital allowances from any adjusted profit figure to give us a tax-adjusted trading profit figure. And this, therefore, for our exam, in terms of SBA, we're only going to be talking in terms of construction on or after the 6th of April 2020. We yet to deal with companies and corporate tax, but when we come to corporate tax, we'll see that we don't deal with income tax years for individuals. We deal with financial years. And financial years kick off from, again, you suppose you could call it a more sensible date, the 1st of April rather than the 6th of April in any year. And hence for corporate tax, we'll only be talking about construction incurred on or after the 1st of April 2020. We're not going to get any initial allowance or first year allowance here. And because it's a building rather than plant and machinery, it's going to take us a long time to get all of the available capital allowances that we might be entitled to. Because what we're going to get is purely an annual writing down allowance will be available on, as the first issue to contend with, the qualifying cost of a qualifying building, and that's at a rate of 3%. So it's going to take us 33 1/3 years, therefore, in terms of the availability of this 3% per annum straight line based on original qualifying cost for this SBA to become fully available. But hey, if you've got the opportunity to take a capital allowance and reduce your trading income, where previously we didn't have that allowance, it could only be a good thing. So it is new from June 21 onwards, given that we're only looking at construction incurred on or after the 1st of April 2020, probably again the June 21 exam. It is the first exam we can see it in. It's going to feature in this round of exams. Examiners are like kids with new toys. They can't wait to use them. So when something is introduced to the syllabus, then it is usually, again, pretty quick after that introduction that it will feature in the exam. And of course, it's a lot easier since we had this new style of examination involving objective testing questions. It's far easier given that section A, 15 questions spread across the entire syllabus. It's very easy to pick up an individual technical point and test it in the format of an objective testing question. Now, of course, it could still feature in section C, where we'll be seeing 15-mark written questions, both for income tax. It may be an income tax question involving the unincorporated trader and establishing the tax-adjusted trading profit of that particular trader. So it could be tested there. Or in the 15 marks, again, Section C question for corporate tax, again, the company, and for its corporate tax computation, again, as we'll discover then, establishing a tax-adjusted trading profit of the company. We could see the availability of this capital allowance. Again, possibly early on, it may well be that we are more likely to see it in the context of a Section A question. All right, but again, I would expect to see this topic being tested in this next round of exams. Not going to be tested in all, whether it comes up in June 21 or the one after that or the one, I don't know. But again, you walking into the exam, it's something you need to know. Having said that, everything that you find within these notes is basically what you need to know. Again, there are a lot of other peripheral issues contained within any study manual that you may have chosen to acquire, but the stuff that is in here is stuff that you really, really need to know to be able to pass this exam. So, for such construction costs incurred on or after the 6th of April 2020 for income tax unincorporated traders and corporate tax incorporated traders, there we get this annual writing down allowance at a rate of 3% straight line based on original qualifying cost. It says there of a qualifying building. So what are they? Qualifying buildings will include, well, the things you'd expect to see. If it's a manufacturing business, factories. It could be wholesaling or indeed manufacturing or retail, warehouses. And not just there, the factories or warehouses, but also offices. Along even with, though, I don't suspect it will be bothering us too much. Both wholesale and retail properties will be included, but also including, this probably won't come up much, cost of walls, tunnels and bridges there. Probably not too many of those going to be, unless you've got a huge site that we're dealing with. On a smaller concept, any part of a building used as a dwelling house along with land will not qualify for SBA. Again, you get properties like you might have a shop on the ground floor and living accommodation above that shop in terms of, say, retail premises there. The part that is attributable to the dwelling house where somebody lives, that is not going to qualify for SBA. Only the part used within the trade. Where an unused building is bought from a developer and the price paid, excluding the value of the land, will be eligible for the SBA from the time that the property is brought into a qualifying use. So here, whether we're talking about buying from a developer or we have constructed the building ourselves, it's much more likely to be bought from a developer, I would think here. We don't get the capital allowance on the cost of the land. It is a structures and buildings allowance, not a land and buildings allowance. So the cost of the land is not going to qualify for SBA. And it will be eligible from the time that the property is brought into a qualifying use. Now again, that, as we've just said, is principally and probably will be for us when it's brought into use within a trade. But this would include, again, such properties that are being let out. Hence, if a building is only brought into such use part way through an accounting period, then the WDA must be time apportioned. Now, this is very different to what we saw in the context of plant and machinery, where the date within an accounting period that we happen to buy an item of plant and machinery was never a factor in determining the amount of allowance that would be available. For example, a writing down allowance. The only issue that impacted on the amount of writing down allowance that was available, and it was equally true for AIA, but in terms of WDA, was purely the length of the accounting period itself. If that was other than 12 months, then you would time apportion. But again, when you bought that item of plant and machinery, within a 12-month, within a 6-month, within a 15-month period, it didn't matter. What dictated the level of WDA was the length of the period itself. Not so here with SBA. What we see here, it's again, as we have said here, will be eligible from the time the property is brought into a qualifying use, i.e. most likely for us, as we've said, when we start to use it within a trade. And that therefore means that we may have bought it partway through the accounting period, but we don't start to get this 3% writing down allowance. We don't start this 33 1/3 year life of the structure, of the building, until it's brought into use. That is the time apportionment exercise we will do. How many, to be of course as ever done to the nearest month, how many months is it? Not from the date when it was originally acquired, but from when it was first brought into use to the end of the accounting period in which it is now being used. What is that length of period? And that will dictate the WDA. So a very different scenario to what we dealt with on plant and machinery. Expenditure which qualifies as plant and machinery cannot also have SBA. Like expenditure, we would do work in relation to maybe installing plant and machinery. Integral features, all of these ranked for their plant and machinery capital allowances. They are excluded, therefore, from structures and buildings allowance. Right. So a little look at illustration 1 here to show how it is we will determine the amount of SBA that is available. Here, as we're dealing with income tax, we'll be dealing with an unincorporated trader. So we've got a trader prepares accounts to the 31st of March in each year, and on the 31st of October 2020 bought a new warehouse from the builder at a cost of £240,000, which included the land valued at £90,000. Right, a warehouse is a qualifying building, but we only want the cost of the building, not the cost of the land. So the first thing we do there is to pick up that the overall cost was £240,000, but that included the land at £90,000. So we exclude the land, take the 90 from the 240, we're down to a qualifying cost of £150,000. When will the 3% on that 150,000, when will it be available from? Not necessarily when it was first bought, but when it was first brought into use. And what are we told here? The warehouse was then used in the trade from the 1st of January 21. Well, the business, the trader, prepares accounts to the 31st of March. We have brought it into use from the 1st of January 21. So we will be talking about the year ended 31st of March 21 as being the first accounting period from which any SBA, or for which rather, any SBA will be available. What will it be? Well, we've already established that £150,000 is the qualifying cost of the building. It's 3% per annum, but we can only have it from the time it was first brought into use to the end of this accounting period in which we first brought it into use. We brought it into use from the 1st of January 21. It's in the year ended March 21, and hence that is 3 months. So, assuming my maths is correct, 3% of 150,000, that therefore would be £4,500. Take 3/12 of that, and that therefore should entitle the trader to an SBA of £1,125 for the year ended 31st of March 21. From then on, from the year ended 31st of March 22, from that accounting period, then a full SBA of £4,500 will be claimable. And if nothing else were to happen, each year up until we've had 33 1/3 years worth of life of that building in our trade, each year we'd be claiming 3% per annum, straight line on original cost, the £4,500. What may happen, of course, is we don't stay in that building for all that time. We sell the building. So what happens in relation to the sale? Now, this is going to bring in something as yet we've not studied, something we know about, and that's the existence of capital gains tax. Now, in terms of capital gains tax, a term we may have briefly used once upon a time, but you'll see it at the start of chapter 12 that begins our detailed CGT studies. We are dealing with the chargeable disposal, which is principally the sale. The chargeable disposal of a chargeable asset, something that when disposed of may therefore give rise to either a chargeable gain or indeed an allowable loss. Chargeable disposal of a chargeable asset by a chargeable person. Here we're dealing with an unincorporated trader, an individual. In a corporate tax context, we'd be dealing with a chargeable person, the company. And then any such gain would be subject to corporate tax rather than CGT as it is for an individual. But here, on the sale of the building, there is no balancing adjustment for purposes of capital allowances for the vendor. But instead, any allowances claimed to that point of sale will be added to the sale proceeds of the building in computing any chargeable gain or indeed in computing any allowable loss that might arise on the sale. So when we have the sale of this building, although it's ranked for capital allowances from the time it was first brought into use within the trade, there is no balancing adjustment that arises in relation to the sale of the building. So on the sale, all we'll have is, at the point of sale, we'll have our writing down allowance coming to an end. But what is going to happen, although there won't be a clawback in any way of those allowances that we've claimed through our trading income assessment, there is no balancing adjustment to do there. There'll be no balancing charge that could claw it back. Of course, if the value's gone down from when we first acquired it, there'll be no balancing allowance either. All we've got to do for the vendor in this example is to work out what is the capital allowance up until the point of sale. But then, for CGT purposes, in dealing with the unincorporated trader, for corporate tax purposes, when dealing with the incorporated trader, then when we deal with this, we're going to have to compute a capital gain on the sale of the property. And in computing that gain, as we see here, then we're going to have to add up the allowances that we've taken. So all the years at 3%, plus in the year that we acquired, and in the year of sale, a time apportioned figure of SBA. This SBA will again be time apportioned in the accounting period of sale up to the date of sale. So just as we have just done in terms of when we bought it, from the time it was first brought into trading use to the end of the accounting period, now in the year of sale, quite simply, it's from the start of that accounting period through to the point of sale. So let's put that theory into practice, therefore, here in illustration 2, where we have to deal not just with who we've spoken about, the vendor in relation to the sale of that particular building, but also we've got to deal with the buyer and see what allowances, if any, may be available to that buyer. So here in illustration 2, we're continuing on with what we saw in illustration 1. So assume that, let's get the pen to work, Assume that the trader in illustration 1 continues to use the building in his trade until the 30th of September 22, at which date the warehouse is sold for proceeds of £700,000, and that, we're further informed, includes £120,000 for the land. Now, what we said we would do is to establish in the accounting period of sale what again would be a time apportioned writing down allowance. Still the same figure, 3% straight line based on the original qualifying cost. But just as we did in the accounting period of purchase, so too do we deal with that in the accounting period of sale. We compute a time apportioned WDA. But in relation to the sale itself, there is then no balancing adjustment for the vendor to deal with. There's going to be no adjustment to the capital allowances computation of that period. We will simply take the time apportioned WDA up to the sale point, and that is it. But it's not it in the full extent of what happens at that point of sale. Because as we saw in that previous note at the bottom of the previous page, that the amount of allowances in total that have been claimed there by the vendor, those allowances will now be added to the sales proceeds in computing the chargeable gain. So let's work it one step at a time. First of all, we need to know which is the accounting period of sale. Now, you will recall that the illustration 1 started with our trader who prepared accounts to the year ended 31st of March. And what we've seen, as above, at the bottom of the previous page, in that accounting period in which the building was constructed, we were able to claim 3 months' worth of the available annual WDA, and we took £1,125. For the year ended 31st of March 22, the building was used continuously throughout that period in the trade, and therefore a full 12-month annual writing down allowance. But now in the year ended 31st of March 23, the building is sold. Here's our sale date. It was used in the trade up until the 30th of September 2022. Now that, of course, is some 6 months into the accounting period of sale. As we've just seen, that is the year ended March 23. So we need to take the time apportioned WDA. The annual figure is, as we know, 4,500. We've got 6 months of use within that period to the date of sale, and therefore 6/12 will be £2,250. Now that is the figure to include in the capital allowances computation of that original trader for that year ended the 31st of March 23, to be added along with all the other plant and machinery capital allowances available and deducted, as we always do, from the adjusted trading profit in deriving the tax adjusted trading profit figure, to include then within the relevant income tax computation of the taxpayer for the relevant tax year of assessment, something we'll be talking about very soon as we move to Chapter 6 and deal with basis periods, the means by which we relate any given profit period, accounting period that a trader has traded in. How do we relate any such period to the time period for which profits will be charged to tax, for which they will be assessed, i.e. the tax year? Well, that awaits us in Chapter 6. But what we have here is, in that accounting period of sale, time apportioned WDA, normal capital allowance, no balancing adjustment in relation to the capital allowances computation, and instead a revised capital gains calculation. Now, as we can see here, we've got total allowances that have been claimed over the period since first construction. Costs were incurred when we brought it into use to the point at which it has left our use, we have sold it. Now, as we said, chargeable gains we've only discussed in basic form in our introductory lectures right at the very start, before we started our technical chapters from Chapter 2 onwards. But it's a basic calculation that we're talking in terms of. What makes exam questions more interesting and therefore demands quite a few chapters in relation to capital gains is the problems that attach to that calculation of the gain, or indeed a capital loss in all the different circumstances that we might meet, both when dealing with trading assets, those used within a trade, and others that are purely investment assets. But the basic premise is a simple one, that all we're going to do, the basic calculation of a chargeable gain, is a simple one. We deduct any and all allowable costs of an asset from its sales proceeds. So whatever we sold it for, less the allowable costs, that would come out to either gain if we sold for more than those costs, or loss if sadly we sold for less than those costs. But in this situation, the sale proceeds of the property, which will include land, there is no separation out now between the building cost and the land cost. When it comes to capital gains, this is a single asset, the property and the land upon which that property stands. It's a single calculation of a gain. We will want to know the entire sale proceeds of that particular property and deduct all of the allowable costs. So we do not separate out in capital gains between the property based on the land and separately the building. We had to do that for SBA, that was purely the cost of the building, but not so for capital gains. And those sale proceeds of the property, as we've said, including land, will now be increased by the capital allowances claimed over the period of use by that trader, and he was able to claim £7,875, as we saw in that calculation there. So the chargeable gain would be a simple one. Our sale proceeds, we sold the entire property, land and buildings, for £300,000. We add to that the capital allowances claimed over the period of use within the trade, and that's our revised proceeds, away from which we deduct our allowable cost. And if you go back, I think we discovered that we had the building was 150, the land was 90, the total was 240, and therefore there is our allowable cost. Take the cost from those proceeds and we have our chargeable gain. And that chargeable gain, based on the date of sale, will appear in the CGT computation, separate to the income tax computation, will appear in the CGT computation of that trader for the relevant tax year in which it arose. Well, the sale date, as we saw, was it 30th of September? Yeah, there we go. 30th of September 22. That falls in the 2022-23 tax year, the 22-23 tax year. So in that tax year, in the capital gains computation, there will be this chargeable gain of £67,875. And that clears that property out of the taxation books of the vendor. And so we move to the buyer. What is the buyer now going to be able to claim? Well, thankfully, this too is a simple calculation because we've already done it. We pick up with the buyer what the vendor had in terms of an annual WDA. So the trader buying the property will simply continue the same 3% claim on that original cost of the building. Now we know that in our example, that's £4,500 in each accounting year. So for a full 12 months for our capital allowances computation, for a full 12-month accounting period, it's £4,500. So what we don't know yet, but I'll suggest to you now, that the buyer prepared accounts to the 30th of June. Obviously, in an exam question, you're going to have to pick out when you deal with such a sale of a property. We're going to have to look very carefully at the question, are we dealing with the vendor? Are we dealing with the buyer? To know, therefore, which particular trader is relevant to it. Is it the sale we're talking up and what allowance, what capital gain may be chargeable in relation to the vendor? Or in terms of the buyer, quite simply, what allowance will they be able to claim? So the buyer prepared accounts to the 30th of June each year and immediately brought the property into use on the 1st of October 22. The sale date, 3rd of September, we immediately bring it into use, therefore, on the 1st of October 22. Then it would have been purchased in the accounting year ended 30th of June 2023. So again, we look at the transaction date, 30th of September. Did we bring it into use? Yes, we did. So just take it from the 1st of October. 30th September, 1st of October, does not matter. What we have here is 9 months of the buyer's accounting year ended 30th of June 23. 9 months of that period are from the date when the property was purchased through to the end of the period. And for the period would have been used in the trade for a period of 9 months and would therefore give rise to a claim of 9 months worth, again of that original annual SBA of 4,500, and 9 months of that, all being well, is £3,375. We're then off and running with that new owner of the property, and for each full year, the next and the first full year of ownership, the year ended 30th of June 24, full annual WDA of £4,500 would be claimed, and that would continue on until all the original qualifying cost had been claimed. That would continue on through. Or, of course, until such time as this particular trader then sells that property. And again, we go through the same process for the vendor, working out in the accounting period of sale, a time apportioned WDA, claiming that WDA on their capital allowances computation, and then in the capital gains calculation for the trader, adding in the allowances that that trader has claimed to the sales proceeds. Inevitably, therefore, if there is a gain, increasing that chargeable gain. So effectively, the benefit that of the capital allowance gain of accounting period by accounting period, a deduction against trading profit, when that property is sold, then it's going to give rise to a capital gain. Now that's moving it from income tax being assessed on the unincorporated trader's profits to now CGT being assessed on the individual in respect of their capital gains. What we might also have to see, just to finish off this area now, is that we may have renovation expenditure. So if renovation expenditure was incurred on a qualifying building, and that renovation expenditure is again in income tax from the 6th of April, the start of a tax year, or the 1st of April 2020 for so far as companies are concerned, because those are financial years as we're learning corporate tax, it too will be eligible for SPA. Again, from the date the building was now brought back into use. This SPA claim would be entirely separate to any claim, if indeed there was one available, when was our construction cost incurred, for the original cost of the building. That renovation expenditure will have its own 33 years and 4 months life with our 3% straight line per annum calculation based upon it. It goes in to its own separate computation. If in an exam question, something again now stated by the examiner, if a question states you are dealing with the purchase of a building, rather than as we've been dealing with SBA, the construction of a building, then no SBA will be available unless the question explicitly states that it is able to be claimed. So again, you're going to know if they say purchase, they're going to tell you if SBA is available. You are not otherwise going to deal with SBA on the purchase of that building. Obviously, what you have when a second user of that building buys is, of course, then referenced back to the first user, and again will continue on with the allowance claimed by that first user if it's still within its life. But if you're dealing with the purchase building, no SBA, we only get SBA on construction, unless, of course, you're told otherwise. Again, as ever now, at the end of each chapter, we're told what work there is to be done. Quite often in terms of the technical article, Finance Act 2020 update, there may be significant issues to look at, as there was regarding Chapter 2. And for other parts of this where there's been little or no change, there is very little, if anything, for you to be aware of. But check out that. You'll find that there is a significant section here in terms of capital allowances, both dealing with plant and machinery and giving examples thereof, and also structures and buildings allowance, and also giving examples on that. So plenty there for you to get your teeth stuck into. Work through that. Again, as ever, when you work through those notes and those examples, don't just look at the question and read the answer. You work that answer for yourself. You don't simply be able to look at an answer and say, oh yeah, that looks right to me based on that question. You need to be able to work it out for yourself. So don't audit those answers. You prepare those answers for yourself and then check it out. Of course, when done, you practice questions again to give you the further practice that you need. Okay, so if we put together what we saw in Chapter 4 and what we've now seen in Chapter 5, for any unincorporated trader, for any accounting period, whether we go from when we started to trade to when we cease trading and anything in between, for the accounting period, we'd always be able to work from the statement of profit or loss for that period, picking up our net profit at the bottom of that statement of profit or loss, adjusting it for taxation purposes, making it acceptable for tax purposes. That will involve a significant amount of work on your part. It will involve the add back of the many and varied non-allowable expenses. And in relation to one of those, probably the most famous one, the depreciation charge, well, that's then where Chapter 5 comes into play. And again, to compensate us for the lack of deduction allowability for depreciation, we get capital allowances. Chapter 5, as we've now come to the end of, you'll be happy to hear here. Chapter 5, capital allowances, that's how we get tax relief for qualifying capital expenditure incurred, whether that be as given the different types of plant and machinery that we may see purchased, or whether now, fresh from the June 21 exam onwards, whether we're dealing with structures and buildings allowance. Plenty of you to work on. Those areas of adjustment of profits and capital allowances will be tested in every exam. They are basic fundamentals that need to be known. Now, whether it's through a series of individual questions in terms of Section A or in Section B, Section C, I should say, on a written question, we are talking in terms of a full-blown, here's the statement of profit or loss, you pick up the net profit, you do the adjustment of profits, here's a list of additions and disposals of plant and machinery, and even now possibly a property there used within the trade, and you work out the capital allowances. Take the capital allowances away from the trading, adjusted trading income figure, and you've got your tax adjusted trading profit. And that work could be done either in the income tax question, where you're dealing with an unincorporated trader, or in the corporation tax question. Again, we've only had our introductory lectures to introduce us to that tax. We do not know any detail. But yes, where do we think a company's profits that are to be subjected to corporate tax, where do we think that most, if not all of that profit will derive from? It will be its trading activities. So yet again, you'll need to use, with just a few differences between what you saw in Chapter 4 on adjustment of profits and what you've seen in Chapter 5 on capital allowances, there in the income tax system, just a few adjustments for corporate tax, if anything, making it easier in corporate tax in the areas of both adjustment of profit and capital allowances. That exercise of adjusting up the company's net profit per its statement of profit or loss to get its trading income assessment after adjustment and after deduction of capital allowances, you could see it there. So those two chapters are hugely important to you, because either in Section A or in Section C, you're going to see some amount of work. It has to happen. Obviously, we don't get to see these exams now. We only get a cross-section of questions every 6 months, one exam's worth. That's all we see. And then only of the written questions. So again, it is so fundamental that those areas will be examined. Make sure you've got that. Okay, once you've got that tax-adjusted trading profit, where Chapter 6 then takes us to is how do we relate what is that tax-adjusted trading profit for an accounting period to, as we know, the income tax year in which that profit pardon me, will be assessed, and the income tax computation upon which it will appear. For which tax year will that profit be assessed? How do we link the two? Because unincorporated traders don't all prepare their accounts to the 5th of April, synonymous with the tax year. So given a choice of any accounting date, how do we relate that accounting period of profit to the tax year in which it be assessed? All of that and more indeed in Chapter 6.